Portfolio management process introduces the structured approach investment professionals use to manage client portfolios within the program. Portfolio management involves constructing and maintaining investment portfolios that align with an investor's objectives, risk tolerance, constraints, and financial circumstances. The process integrates economic analysis, asset allocation, security selection, and ongoing monitoring to achieve long-term investment goals. Effective portfolio management recognizes that investors differ significantly in their return expectations, liquidity needs, tax considerations, time horizons, and tolerance for risk. Consequently, professional portfolio management requires disciplined planning and continuous evaluation, rather than isolated investment decisions. The topic establishes the framework that guides institutional and individual investment management practices across global financial markets. The first stage of the portfolio management process is planning. During this phase, investment managers assess the client's financial situation, investment objectives, risk tolerance, legal constraints, tax considerations, liquidity requirements, and time horizon. These factors are documented in an investment policy statement, IPS, which serves as the foundation for all future portfolio decisions. The IPS clearly defines return objectives and acceptable risk levels while outlining any relevant restrictions or preferences. Proper planning is critical because unsuitable investment strategies may expose clients to unnecessary risk or fail to meet long-term goals. The IPS must also be reviewed periodically and updated whenever significant changes occur in the client's financial condition or objectives. The second stage is execution, where the investment manager constructs the portfolio according to the IPS guidelines. Execution begins with asset allocation decisions, which determine how capital is distributed among asset classes such as equities, fixed income, cash equivalents, and alternative investments. Asset allocation is heavily influenced by expectations regarding macroeconomic variables including inflation, interest rates, and economic growth. Portfolio managers may use top-down analysis by first evaluating economic trends before selecting industries and securities. Alternatively, bottom-up analysis focuses on identifying attractive individual securities based on company fundamentals regardless of broader market conditions. Effective execution seeks to balance expected returns against acceptable levels of portfolio risk while maintaining diversification benefits. The third stage of the portfolio management process is feedback, which involves monitoring portfolio performance and making necessary adjustments over time. Investment managers regularly evaluate whether portfolio returns remain consistent with a client's objectives and benchmark expectations. Market fluctuations may cause asset allocations to drift away from target levels, requiring portfolio rebalancing to restore the desired risk profile. Managers also monitor changes in economic conditions, interest rates, market valuations, and client circumstances that may necessitate strategic modifications. Performance measurement and reporting are essential components of feedback because they allow both clients and managers to assess whether investment strategies are achieving intended outcomes while remaining aligned with the investment policy statement. The topic also highlights the importance of diversification within portfolio management. Diversification reduces portfolio risk by combining assets with imperfect correlations, thereby minimizing the impact of poor performance from individual securities or asset classes. Modern portfolio theory demonstrates that investors can improve risk-adjusted returns through efficient diversification rather than concentrating investments in a limited number of securities. However, diversification may become less effective during periods of severe market stress when correlations among asset classes increase. Portfolio managers must therefore carefully evaluate risk exposures across asset classes, industries, regions, and investment strategies. Effective diversification remains one of the most important tools for managing uncertainty and improving long-term investment stability. Overall, topic demonstrates that portfolio management is a continuous and disciplined process designed to align investment decisions with client-specific objectives and constraints. The planning, execution, and feedback stages provide a structured framework for constructing, managing, and evaluating investment portfolios over time. Investment policy statements guide strategic decisions, while asset allocation, diversification, and performance monitoring help balance return objectives against acceptable risk exposure. Successful portfolio management requires both quantitative analysis and professional judgment regarding economic conditions, market behavior, and investor preferences. For CFA candidates, understanding the portfolio management process is essential because it forms the operational foundation for wealth management, institutional investing, pension fund administration, and professional asset management practices worldwide.